Hi, Crista. Nice to see you today.
Hi, Kevin. Thanks for having me.
The last few episodes that we've had you on, we've been covering the quarterly, so more of a balanced portfolio update. Today, we're going to do something a little bit different, cover fixed income exclusively and the Canadian bond strategy here at Moore. Why don't we start with the big picture? Over the past year, or even year to date, can you please walk us through some of the most significant macroeconomic trends that have been shaping global bond markets, but particularly the Canadian bond market?
Yeah, thanks, Kevin. So this question really does tie nicely in with our macro process. So on the macro side, we do start each year with laying out themes. And these are things that we think are going to affect the economic backdrop or financial markets over the course of the year. At the beginning of this year, we started with three main themes: trade policy, fiscal stimulus, and what we're calling kind of continued tightening of financial conditions. So I'll start by going over those themes, and then I'll talk to one more that we believe is having an impact. So I'll start with the big one, US trade policy. Now, to be honest, we didn't start the year necessarily thinking exclusively about trade because we weren't really sure which direction the US administration would take. Were they going to lean on tax cuts, deregulation, or were they going to focus on trade? We very quickly learned trade was going to be a big focus for them. This had a huge impact to financial markets, particularly earlier this year around Liberation Day. It's also impacted central banks and sort of how central banks think about policy in the face of trade uncertainty. And then it's obviously had an economic impact. I would say over the last few months, we have seen deals in Europe, Japan. We've seen China's tariffs be paused. And this has gone a long way to reduce that uncertainty that existed in financial markets. However, we are still seeing the economic impact of the trade war play out, particularly in places like Canada. Growth is slowing in Canada. Exports are down, 11% year to date. And we're seeing a slower labor market. So although we've seen the financial volatility decline, we believe the uncertainty around trade will continue to impact the economic backdrop. Our next major theme is fiscal policy. This has been a theme of ours for a while, for a few years. We're seeing governments really globally put forward plans to increase spending, whether it's, the US and this big, beautiful bill, or whether we're seeing just increased spending around defense or infrastructure. In Canada, we know we're going to get a budget in the next month or so. We expect to see increased spending there. Even Germany, which is one of the most fiscally responsible countries in the world, has made changes to their debt brake to allow for increased spending. Now, when we think about fiscal policy, it's typically there to fill that growth gap. If your economy is weakening, fiscal spending comes in and helps boost growth and kind of cut off that downside tail. But what we're potentially seeing today is that policymakers are moving towards an increase in fiscal spending at a time where their economy is still growing. And so if you're boosting growth while the economy is at capacity or at full employment, that spending ends up being inflationary. And that's sort of a major theme that I would say the bond markets are sort of wrestling with this year. Our final theme is sort of this tightening of financial conditions, or really it's the idea that previous tightening is still making its way through the economy. We think this is happening in both Canada and the US. In Canada, the sort of mortgage refinancing story is a well-told story. We know it's continuing. We know it's continuing into 2026. It's a headwind to consumer spending. I think what's less appreciated or what's less known is we're starting to see something similar in the US. In the US, rates are quite a bit higher. They're higher than they are in Canada. They're actually above neutral. And so what this means is the Fed has kept rates at a level that is considered restrictive. And we believe that's starting to show up in the economy. If you look at things like consumer delinquencies, auto delinquencies, even home prices are starting to turn negative here. And so this is a theme. It's getting less airtime for sure, but we believe it's contributing to the slowdown that we're seeing in growth, which will obviously impact central banks and therefore interest rates. The last theme I'll touch on is AI. Now, AI is arguably having a bigger impact on equity markets versus the bond market right now, but it is having an impact on current economic growth. When we typically talk about AI, particularly in the context of the economy or the economic backdrop, we talk about the long-term benefits. We talk about efficiencies, productivity gains. What does that mean for the labor market? But what we're actually seeing is there was a bit of a short-term boost to growth related to AI spending, whether it be data centers or just infrastructure around AI. And I think if that continues, AI is not only going to be a long-term sort of secular theme with respect to productivity, but it does provide a near-term positive for growth.
You touched briefly there on central banks. I don't envy their position right now. It's a lot to sort of navigate some conflicting signals that they're kind of getting from the economy. And then, of course, they control interest rates, which has its own impact on inflation and all of those sort of downstream effects or things that are impacted by interest rates. How have the central banks, but let's say specifically Bank of Canada and the Fed, how have they approached interest rate policy over the last little while, particularly in light of this tension on inflation? And what sort of surprised you most about their policy decisions and the market reaction to those decisions?
Yeah, well, I think we started the year with global central banks in easing mode. Now, they were arguably at different stages of their easing cycle, but they all had an easing bias. Then we got the trade war. There's a lot of uncertainty that was created around the trade war. There's a lot of unknowns not just about policy itself, but about how the trade would impact both growth and inflation. And because of this, central banks moved away from forward guidance and took more of a wait and see approach as they monitored how the economy was evolving. Now, more recently, we've seen central banks shift back to that forward guidance and sort of proactively start cutting rates again. The Bank of Canada has eased twice this year, cutting in January and March. They brought their overnight rate to the middle of their neutral range and then really paused in the face of that uncertainty. As I mentioned, they sort of moved away from setting policy based on their outlook and took that wait and see approach. Now, fast forward 6 months, what they're seeing is we're seeing less pass through of tariffs onto prices and inflation than what was initially expected. And we're seeing that the sort of negative growth impact from tariffs and uncertainty is hitting growth and employment. So Q2 GDP was negative. As I mentioned, exports are down over 10%. We're seeing employment declines, and we're seeing the employment declines in both trade and non-trade related sectors. And so that slowdown in growth, while inflation seems contained, prompted the Bank of Canada to cut rates in September. Our view is they will likely continue cutting rates as we believe the downside growth impacts from trade will continue. We saw something similar in the US, where the Fed took a wait and see approach for most of the year. The Fed started the year with the overnight rate at 4.5%. And although their dots suggested they were going to continue easing, they actually paused until recently. And I think it's important to note that unlike Canada, which had lowered their rate to neutral, the Fed paused at elevated levels and therefore kept policy restrictive for most of the year. That changed. Earlier this month, they did cut rates 25 basis points, brought rates down to 4.25. And so although kind of similar to the Bank of Canada, although they're seeing inflation somewhat sticky and above their target, growth has materially slowed and employment has materially slowed. And so they were seeing greater downside risks to their employment mandate relative to the upside risks related to their inflation. Now, I think there's been a lot of questions around Fed independence, particularly on the back of the most recent cut. I think this is one thing that's definitely surprised me this year. And I think this is actually one of the risks that we face in the coming months and years. If you look at Project 2025, it actually talks about kind of narrowing the Fed's mandate, increasing oversight of the Fed. So it's really not unreasonable to suggest that there is a risk that Fed independence may become diminished. Having said that, it's not clear to me that this latest cut was the result of political interference. To me, there is a strong economic argument to be made for the most recent cut, particularly given, they were above neutral, so they were restrictive. They continue to be restrictive. To me, the real sign that, Fed independence has been severed will be when the Federal Reserve is just not setting policy for the economic backdrop, but instead, setting policy to appease a government. And this is definitely a risk, something to be mindful of. arguably we're sort of tiptoeing towards that, but I'm not convinced the latest cut represents that.
And maybe just as a follow-up there, so perhaps, there is this political pressure, but to your point, it appears that there was sort of the economic backdrop to justify the cut. Do you think, sort of flipping that, do you think that perhaps with time it'll sort of come out that, or the data will bear out that perhaps they were even a bit late in this cut, or is this kind of in your view, the appropriate time for them to have taken action?
It's hard to argue that they're late based on kind of the information right now. We have seen a deterioration in the labor market. The unemployment rate is still at a low level, unlike in Canada, where the unemployment rate's actually been rising quite a bit. And then on the growth side, yeah, we got a negative growth print in Q1, but that's sort of rebounded a bit. You could maybe look at the growth side and argue they're a little bit late. But I think overall, yeah, it's tough to based on the information we know now, to suggest that they're late. You're looking at an economy that's full employment, and I think that's why people are debating whether or not this was Fed interference or not. And I think the real key to suggesting that it's not is that they are above neutral. They are restrictive. If they were already at neutral, like the Bank of Canada was, and they decided to ease policy further, I would suggest that that would have been the wrong thing for them to do at this stage. But they are actually, above neutral. They're still restrictive. So they are just getting back to a more neutral level.
Shifting back to Canada a little bit, and also we've talked a lot about the macro and sort of the economic backdrop, the central bank backdrop. Let's talk bond market performance. So, and particularly in the Canadian context, what were the key drivers, again, kind of year to date, last 12 months for the Canadian?
Yeah, so I mean, both rates and credit have contributed to bond market performance this year. I'll start with credit and spreads. Both provincials and corporates continue to grind tighter. As I mentioned, we saw some volatility around Liberation Day, but since then, spreads continue to outperform with lower quality names. So triple B names actually outperforming higher quality names. On average, corporate spreads, that is, have tightened around 10 basis points year to date. So not a material tightening, but a continued grind lower. And we're seeing the same thing on the provincial side. Provincial spreads continue to grind lower, and they're tighter around 6 basis points year to date. With respect to interest rates, it's really mainly been shorter dated maturities that have performed well. With the central bank in easing mode, we've seen 2 years fall around 50 basis points, fives have fallen 25 basis points, and 10s modestly lower. This has really resulted in the curve steepening. 2s, 10s has steepened around 40, 5s, 30s has steepened around 50 basis points. The real sector, almost the only sector that's been underperforming here, is longer dated rates, particularly 30-year bonds. And this really started happening post-Liberation Day. And our take on it is that, the market's looking at an environment where global trade is decreasing, tariffs are increasing, increased protectionism, increased fiscal spending. And they're saying that, this is likely going to cause structurally higher inflation, which does result in the long end being more elevated and causing the 30 years to underperform.
Can understand the impact, potentially higher inflation over the long term. That doesn't affect the sort of medium or short part of the curve as much, just because it's a function really of central banks driving the bus on the shorter part of the curve, or how does that sort of work?
Yeah, exactly. The way I think about it is central banks drive the short end, the inflation drives the long end. And really what that means is, the central banks are looking at the growth picture today, and they're setting policy for growth and inflation. And, and inflation's roughly around the 2%. Where the long end of the curve is potentially suggesting that, 2% is not the right long-term run rate for inflation. It might be something higher. And so that's creeping up in longer dated maturities.
Let's talk a little bit about the strategy that you manage, the Canadian bond strategy. If you could walk us through, given all of the backdrop and sort of market history that you've kind of walked us through, how you were positioned throughout the year in the strategy, and then also areas of opportunity currently that you find most compelling.
Our view was that we were going to see a slowdown in growth in Canada. That slowdown was driven by the factors we discussed: uncertainty around trade, mortgage refinancing. Immigration policy is actually another factor that we think is acting as a headwind. And so that slowdown really would require the Bank of Canada to continue easing policy. and bring rates down to at least the lower end of the neutral range, if not below neutral. And so given that we've been in a steepener all year, which has kind of done well for us. In terms of credit, we did start the year overweight credit, at least modestly overweight credit. We didn't really see the slowdown triggering a deep recession. However, as we learned more about trade uncertainty, as spreads continue to grind lower, we have trimmed credit even more. Even in the face of this sort of uncertainty that's picked up, as I mentioned, spreads continue to grind lower. They're actually now through the lows in Canada, at least, through the lows we've seen post-financial crisis. So we've seen some pretty decent tightening in spreads over the last few months. In terms of where we see value, as I mentioned, we believe the curve is going to continue steepening. So we are overweight that 5-year area, underweight 10s and longs. We do believe the Bank of Canada will continue easing. We see that there are some risks around the secular trends with respect to inflation. And so that could continue pushing the long end higher. On the credit side, we like shorter dated maturities. We think the most attractive kind of area of the spread curve is that 3 to 5 year part of the curve. It really captures the carry. And then given sort of spread compression and given that outperformance of triple Bs relative to single As, we've also kind of started shifting the portfolio into higher quality corporates. So we like banks, utilities, higher quality corporates in the 3 to 5 year area of the curve.
That's kind of the backdrop of, where we're at now, what your kind of views are. Having said that, risks never go away. What are kind of the big things that are keeping you up at night for, somebody that's managing a bond portfolio?
Yeah, I mean, I think the big risk right now, which has been a risk for a while, really is inflation, because that will ultimately cause central banks to tighten policy and raise interest rates. We have seen inflation come down in recent years, but it's been sticky around 2%. In Canada, we do believe that growth slowdown will ultimately drive kind of where inflation goes, but we are mindful that those secular trends, deglobalization, supply chain disruptions, fiscal stimulus, could remain elevated and could continue to push inflation higher. I think on the credit side, we are seeing a modest deterioration in credit. We are seeing sort of a slight increase of leverage, particularly in sort of the non-financial part of our index. And so with spreads at all-time tights and sort of fundamentals slowly deteriorating, there is a risk that something will sort of trigger a spread widening move here.
And then finally, for investors who are perhaps feeling uncertain about bonds, particularly given maybe some of the risks you just mentioned, what's your message for them in terms of the role of fixed income? Obviously, you're a fixed income portfolio manager, so perhaps you're a little biased, but nevertheless, how do you sort of think about the role of fixed income in the context of a balanced mandate in 2025 into 2026?
We still believe fixed income can and should play a meaningful role in diversified portfolios with yields at higher levels, really higher than we've seen in decades. Sort of those high quality bonds can go back and play the role of diversifier, kind of have that negative correlation when equity volatility increase. And we have seen that through various periods of equity volatility increases over the last year or so. The other thing I'll say is with yields higher, we're finally being paid to sort of wait, so to speak, kind of collect our coupon. And the higher yield creates more of a cushion against modestly higher rate moves or spread widening.
Well, I think that's a great place to end. As always, thanks, Crista, and hope to talk to you soon.
Thanks, Kevin.